Okay, so we're looking at depreciation. This is the loss in value of an asset as it gets used up due to wear and tear. Right, whenever you buy machines, equipment, vehicles, they all have a useful life, and the more you use them, the wear and tear will get the better of the machine. So that's why we use depreciation, so that we can be recording as the years pass by, we'll be recording the value of our asset. All right. So here it says compare the straight line, reducing balance, and units of production methods of depreciation for a machine purchased at 50,000 with an estimated useful life of 5 years and a residual value of 5,000. Calculate the annual depreciation expense under each method and analyze the effects on the financial statement. Okay, so we'll start with the straight line method. So basically, we're measuring the life of the non-current asset according to the number of years. So this is the formula for the straight line method. It is the cost minus the salvage value. This salvage value, this is how much you can sell the machine for after its useful years pass. Sometimes it's also called the scrap value. So cost minus salvage value divided by the useful life. So they told us in that question there that the cost of the machine is 50,000. They told us the salvage value is 5,000. So the useful life of the machine is 5 years. So we're going to say 45,000 divided by 5. You're going to get a depreciation expense of 9,000 kwacha per year. Now, in the question, they just want you to calculate the depreciation expenses, all right? But I just want to also illustrate to you how depreciation works, all right? So, whenever you get your depreciation expense, okay, this is the journal entry, okay? You debit depreciation expense or the profit or loss account. Other books you see debit profit or loss, right? Other books you see debit the depreciation expense account. Okay. And then you credit accumulated depreciation. All right. So accumulated depreciation, as the years go by, this accumulated depreciation increases. This is a contra asset account. It's a contra asset account because it reduces the value of an asset. As we're going to see in the balance sheet, we have that section where you have cost, then the accumulated depreciation, then the net book value. Okay, so this accumulated depreciation, it's a contra asset. It reduces the value of assets. So let's just look at how the accumulated depreciation expense account works. All right. So let's say for year one, we've calculated the depreciation expense of 9,000. So on the 31st of December, you credit 9,000. You close the books, right? And you bring the balance brought down on the 1st of January. The next year, right? This 9,000 balance brought down. So it will come here in the next year, in year two. Year two comes by, again using the straight, With the straight line method, the depreciation expense is the same throughout. Okay, it does not change. It is constant. Okay, so every year you'll be incurring this depreciation expense of 9,000. Okay, because it's constant. So in year two, on the 31st of December, you record again the depreciation expense, 9,000 here. All right, then you're going to add it with this 9,000 from the previous year. So 9,000 plus 9,000, 18,000. Right, so in year two, the accumulated depreciation is 18,000. As we're going to see, as the years go by, this accumulated depreciation is going up. And as the accumulated depreciation goes up, the value of the asset is going down. Before I proceed, any questions? Excuse me. Okay, so we bring this balance 18,000. 1st January in year three, bring this balance of 18,000. Year three passes, the depreciation expense incurred for year three, 9,000. So you're going to add 18,000 plus 9,000. The accumulated depreciation of year three is 27,000. All right. And this 27,000, you bring it as the balance brought down in year four. Year four passes again, you have another depreciation expense of 9,000. Accumulated depreciation, you say 27,000 plus 9,000, you get 36,000. Okay, and this process continues on and on and on until you reach zero or the salvage value. So this is how the accumulated depreciation account is working. Now, I want us to see this on the balance sheet. All right, this is on the balance sheet. Well, this is going to give us an idea of what is happening. Okay. So in year zero is the first day of year one. So year zero, when you buy this machine, there's no depreciation attached to it. All right. So the net book value, which is the cost minus the accumulated depreciation, is 50,000. Okay. When you purchase the machine, the first day of year, which is year zero. Year zero is the first day of year one. There's no accumulated depreciation there, so the net book value stays the same. Now, at the end of year one, all right, calculated the depreciation expense, it is 9,000. So you debit depreciation, you credit accumulated depreciation. The net book value, you're going to say 50,000 minus 9,000, you get 41,000. This is the value of the asset at the end of year one. We move to year two. All right. In year two, if you remember, year two, our accumulated depreciation, 18,000. So this 18,000, we are going to subtract it from the 50,000. All right. So 50,000 minus 18,000, the value of the asset at the end of year two is 32,000. At the end of We're going to year three. At the end of year three, if we remember, accumulated depreciation 27,000. So we deduct 50,000 minus 27,000. You get 23,000. We enter year four. At the end of year four, accumulated depreciation 86,000. 50 minus 36,000, we get 14,000. At the end, we enter year five. At the end of year five, accumulated depreciation is 45,000. So you say 50,000 minus 45,000, you get 5,000, which is the salvage value of this equipment. Yes. Any questions? So there I just wanted to provide an illustration. This is not part of this question. So if this question comes in the exam, there's no need to do all of this. You just calculate the depreciation using the straight line method. Once you calculate that 9,000, you end it there. So I hope we've got an idea of how this depreciation works. We move to the, oh, any questions before we move to the second method, units of production? Okay, we can use the units of production where we're measuring the life of the asset based on the number of units it can produce. Okay, so this is also similar to the straight line method, right? The only difference is instead of the useful life here, you have the activity consumption. Okay, for example, if you buy a good, all right, let's say you buy a machine, an ice cream machine, okay, and then the people who produce the machine tell you that this machine can make 100,000 units. After that, it's going to be of no use, or it won't be functioning properly. So this machine is expected to produce 100,000 units. Okay. Here we've just assumed in the question there, they haven't told us the number of units that are being produced. So we're going to assume a machine that can produce 100,000 units. Okay, in the question, they are supposed to give you the number of units. If it's a car, they're supposed to give you the mileage. All right. So, yeah. So, for this example, we've said, okay, this machine, which is costing 50,000 and has a salvage value of 5,000, this machine can produce 100,000 units over its lifespan. All right. So, we calculate the depreciation. So we're going to say cost minus salvage value divided by activity consumption. So we're going to say 50,000 minus 5,000, we get 45,000. So 45,000 divided by 100,000 units, you get a depreciation expense of 0.45 kwacha per unit. Now, since this machine can produce 100,000 units, you as a business, you must know per year how many units do you want to be producing. Okay. So let's assume what we will be producing 20,000 units each year. Okay. Year one, 20,000 units. Year two, 20,000 until we reach year 500,000 units. So if we'll be producing 20,000 units annually every year, our annual depreciation expense is going to be 0.45 kwacha per unit times 20,000. You get 9,000 kwacha per year. Now, unlike the straight line, sometimes maybe let's say in a year you produce more than you had. Let's say maybe if you produce 5,000, 25,000 units that year, you multiply it by this amount. Okay, so this one can be constant, but other times it can also fluctuate because it will depend on the demand that year. Okay, you might budget to want to be making 20,000 units. Then you find your demand increases as the years go. So maybe you might need to be making now 30,000 units per year. So with the units of production method, it can be constant if you be producing the same amount per year, but it can also change if the number of units you're producing in the year um, changes. Any questions? Okay, we go to the third and final, the reducing balance method, where your depreciation expense in the first year is going to, in the early years, it's going to be high, but as the years go by, the depreciation expense will be reducing. All right. So with the reducing balance method, you're supposed to have a rate, right? You need to have a rate so that you can calculate. So in this question, we were not given the rate. So we need to tabulate the rate for ourselves. So here there are two formulae you can use to calculate the rate. This one is the easier one. Okay. So we say the depreciation rate, we say it's equal to 1 minus the residual value, 5,000, residual value 5,000, cost 50,000 to the power 1 over 5. 1 over the useful life, which is 5. Okay, so what you need to do next, you say 5,000. Let's get our calculators, colleagues. 5,000 divided by 50,000. What value do we get? 5,000 divided by 50,000. Am I hearing a 0.1? We get 0.1. Then in your calculators, it says 0.1. So instead of putting a fraction on your calculators, it's okay. This 1 over 5, you can convert it to a decimal. Okay, 1 divided by 5, that is 0.2. So in your calculator, you can put 0.1 to the power 0.2. You get 0.63. Have you, has everyone tried this in their calculators? Are you getting 0.63? 1 minus 0.63, you get 0.37. To convert it into a decimal, this is 100 times 0.3, 37%. Yes, 37%. So this is the rate we're going to use for the reducing balance method. Any questions before I begin? All right, so this is the formula for the reducing balance method. It's cost minus accumulated depreciation multiplied by the rate. So in year one, cost 50,000, accumulated depreciation 0. The depreciation rate is 37%. So you're going to say 50,000 times 0.37. You get a depreciation expense of 18,500. Now, with that question, you're just supposed to end here. You just calculate with the reducing balance method, calculate the depreciation, then you're done. But for understanding's sake, let's just continue going year by year. Year two, cost minus accumulated depreciation. So you put here 50,000 minus 18,500 times 37%. So 50,000 minus 18,500, you get 31,500 times 0.37, you get 11,655. So as we said, with the reducing balance method, the depreciation expense as the years go by is going to be reducing. Okay, let's just look at year three. Okay, year three, cost minus accumulated depreciation. So you say there's the 18,500 here plus 11,655. So let's see, 50,000 minus 18,500 plus 11,500, you get 20,000. Multiplied by 37%. So 20,000 multiplied by 37%, 0.37, you get 7,400. Right, so the process continues. Okay, the next year, if it's year 4, you add this 7,400 with this here and calculate. So that's how the reducing balance method is done. So there was a second part of this question which says, how do these methods of depreciation affect the financial statements? Okay, for the straight line method, okay, in terms of the statement on profit and loss, you're going to have a fixed expense. Okay, you have a fixed expense. So yes, your profits, your the amount of profit you make can be changing, but that depreciation expense is going to be fixed. All right. In the balance sheet, the value of the asset reduces in a constant manner. As you can see here, every year you just deduct, every year you're always incurring the same depreciation expense and just adding it to the accumulated depreciation. All right. So the value of the asset will go down in a steady manner. Right. With the units of production method, also if you are producing the same amount of goods over and over, then you're going to have a fixed depreciation expense. And also in the balance sheets, the value of the asset will reduce steadily. But in reality, you won't always be producing the same amount every year. The amount might be changing. You might produce 20,000 this year, 25,000 the next year, 23,000. So with that, when that's happening, your depreciation expense will be fluctuating in the statement of profit or loss. And then also the reduction in the value of the asset is going to be also fluctuating. Okay, because there's a possibility the depreciation expense might be higher or lower that year, so it will be fluctuating. And for the reducing balance method, as we can see, the depreciation expense is reducing every year, right? So if that expense is reducing and this is giving you room for more profit, okay? And then also the on the balance sheet, when we talk about the value of the asset, in the first years, the value of the asset will be dropping at a high rate. But then as the years go by, the expense reduces and also the value of the asset starts dropping slowly. Yes.